Good afternoon, everyone. Thank you so much for being patient with us. We had some technical difficulties due to which the session was delayed, and I apologize for that. We're just waiting for Rishabh sir to come on. Give us a few minutes. Thank you. Good afternoon, everyone, and good afternoon, sir. I apologize for the delay and inconvenience caused to you, and thank you for being so understanding and accommodating. Uh, we'll begin with the session. I welcome you to this final day of the 7-day International Level Faculty Development Program titled Pathway to Modern Accounting Era, organized by the Internal Quality Assurance Cell and Department of Accountancy in collaboration with Western India Regional Council of ICAI. Before we begin with today's session, I would like to give a brief introduction of our guest speaker, C. Rishabh Jain. He is a chartered accountant, LLB, certified in Indian accounting standards, forensic accounting and fraud detection. He is the CEO and founder of Marks Network, spearheading his enterprise into the large audit and Indian accounting standards advisory. He takes a keen interest in learning about the latest updates across professions in India and globally, with a major thrust on the means and applications of technology in professional services. Sir strongly believes that Indian firms should realize the vision of the Honorable Prime Minister and strive to have an Indian firm in the top firms globally. He has founded Marks Network with the belief that and purpose of unlocking potential of Indian practicing chartered accountants. He believes that true power in today's time is knowledge, and he wishes that India becomes a global knowledge powerhouse. Sir, it is an honor to have you among us, and I'm eagerly looking forward to today's session. I now request Rishabh sir to take over.
Yeah, hi. Good afternoon, all. Hope I'm audible and the sound is proper.
Yes, sir, you're audible.
All right. Okay. Thank you so much for such a kind introduction. Uh, Apologies on behalf of the organizers for the technical glitch. I was myself trying to get in and out of the meeting, but we are here finally. I hope it's a normal afternoon time, so I hope people are not very sleepy, and I hope my topic does not push you towards sleep further. But looking at the time we have, I think we'll go straight away. First of all, thank you to WRC of ICI. Thank you to Nirmala Memorial Foundation for giving me this chance to share with this august audience as to what is IND AS and trying to navigate whatever we do to the best possible. Having said that, I believe there have been a good six sessions that have already happened, and I believe they've probably gone into a very good manner. And I believe we can also take this and we can have a good capping of all the sessions that have happened till date. All right. So just give me a minute. I'll share the screen and we'll have it going. All right. I hope my screen is visible to one and all. Yes, sir.
Yes, sir, it's visible.
All right. All right. So let us start with the topic today. If at all there are any technical issues, if at all there is a sound problem or a video problem, please feel free to interrupt me so that I can stop and I can probably start from where it was inaudible from. All right. So just my introduction has already been given. I have keen interest in reading financial statements, and now India has also, from 2016, gone onto the global map where they have tried to adopt IFRS. IFRS was taken, I believe, by Dr. CA TP Anand, and I believe he's covered a good number of points as to the measurement, recognition, and a good overview has already been given by him. So IFRS is basically global accounting standards. I'm sure Mr. TP Anand has mentioned that in detail. What we have in the Indian context is that India has not totally adopted the IFRS that was there globally. The Indian regulatories realized that our market is dynamic, our market is a bit different, and that is the reason they have found it more prudent to have financial standards that help denoting an actual case-to-case basis rather than simply copy-pasting what is followed globally. And that is how IND AS, which is Indian Accounting Standards, was born. As on this date, IND AS is something that is majorly followed by listed entities that have any of their securities listed in India or outside of India. And other than that, companies with a sizable amount of net worth, about 250 crores, subsidiaries of companies that are listed, so on and so forth, are entities that are asked to follow IND AS. Now, having said that, IND AS, probably if I have to give a very vague number, is 95 or 97% similar to IFRS. There is probably only a 3% or a 5% diversion, which has been made so that the whole IFRS has been catered to on the Indian context and adopted as IND AS. Now, let me first, before hopping on to the topic, which is financial instruments today, let me run through why we have picked this up as a topic today. It is because financial instruments is probably, if you have to ask me, one of the biggest upgrades or changes from the from the accounting standards, which also we call as IGAP, which is the Indian GAAP, has been financial instruments. And more so, I'll tell you why that has happened is because in Ind AS, there are two concepts that have evolved and that have come up. One is fair value measurement, right? In Indian IGAP, where we had AS 13, right? Everything was measured either at cost or lower of cost and market value of whatever your investments were. But on the Ind AS front, we have taken a major upgrade where there are two things that have been very strictly recognized. One is that there should be a fair value measurement. So at every reporting date, at every balance sheet date, there should be a fair value of the assets and liabilities that should come out. And the second is what we call as time value of money, right? If I have 1 lakh rupees today, will they be the same 1 lakh rupees if I keep them in an FD for a year, or if I keep them in my bank account or my current account where there is no interest? It will not be, right? Because the inflation is at 6, 7, 8%. So we need something that can take that into account. We need that, and that is why it is also taken up in Ind AS to take it in the time value of money, bring in all the changes wherever they can. We'll study this in detail when we come to the topic. So before that, let us just run through the content of the presentation. I am giving a full disclaimer. This content is heavy, right? It is a heavy content that we have taken up, but it is very difficult to cover these three Ind ASs which deal in financial instruments in 2 hours. If I'll be very honest to you, even in these 2 hours, we are only scratching the surface. But what I aim to do with this session is that at least after this session has ended, there will not be terms that you will be, you feel are alien to what you would have heard so far. I believe at least there will be a good familiarity that will be there with basic concepts of financial instruments. If you look at any balance sheet, if you look at any annual report, then I believe you'll be in a much better position to assess as to how these have been derived and what is the methodology used, what is the recognition, what is the measurement, initial as well as subsequent. So running on to the content, first, although I've covered a bit of introduction, we'll still have an introduction about the financial instruments that are the Ind AS that is talking about financial instruments. In financial instruments, we'll then go on to define what is a financial asset, what is a financial liability, and what do we define as equity. We will also have a proper bifurcation coming in between liability, which is financial liability with your equity. We will see how treatment is done of interest, dividend, losses, and gains that are accrued over years or paid over years. And after that, we'll see how do you classify a financial asset? How do you measure it subsequently? And we'll go into a lot of nitty-gritties that you can see on the screen now. What is a business model assessment that needs to be made? What is a contractual cash flow characteristics test that needs to be made? What is the criteria for amortized cost? What is the criteria for FVT OCI, which is fair value through other comprehensive income? What is the criteria for measurement at FVTPL, which is fair value through profit and loss account? I understand these terms are probably sounding like gibberish at the moment, but through this session, we'll get acquainted with that. And through the session, we'll look at having that done. Then we'll look at what is a financial liability. How do you classify? How do you subsequently measure a financial liability? And what is compound instruments? This, I believe, in a nutshell for today's session, will cover much more in detail as to what financial instruments are. I believe there may be a requirement of another 2-3 sessions to get into exact technicalities, exact how the numbering is done, how calculations are done. But at least this can serve as a fresher or an introductory session that is there with us. Right. So as I've explained earlier, we had AS 13 under the accounting standards, which was basically talking about accounting for investments. Now, investments, as you all know, is obviously a financial asset. So till now, in the IGAP, in the Indian GAAP, the accounting standards were only talking about financial assets. This is the first time where financial liabilities under Ind AS has been taken up and comprehensive measurement standards have been developed around it to make it in line with whatever is happening globally. And as you can see with the issuance of the company's Indian Accounting Standard rules, that all specified companies have to follow IND AS, and there is a good number of standards that we can cover through IND AS. Now, when we talk about IND AS, there are three specific standards that are covering IND AS. The first is IND AS 32, which is talking about the presentation and classification of financial instruments. Second is IND AS 109, which is talking about recognition, derecognition, classification, measurement of financial instruments. And the last is what are the disclosures, which is IND AS 107, is basically about what are the disclosures required in respect of financial instruments. Now, you might be confused with how these are numbered. They're numbered as 32, 109, 107. Basically, these are replicas of what was followed by IAS as well as by IFRS. And that's why the numbers have been kept to be identical as to what they are internationally. So when there is a global investor or when there is a foreign investor that is going through the balance sheet of, say, Reliance Industries Limited, they can easily relate to what this is. And major changes in balance sheet classification and P&L classifications have also been made when IND AS was brought up, and the whole IND AS was completely changed to that extent where the balance sheet is looking very different. If you pick out what is a balance sheet that you've seen over time, and if you pick out the balance sheet that you will see of Reliance, you'll feel that ये तो जमीन आसमान का फर्क है. The difference is that stark. The terminologies used are that complex. So let us try to break down these complex terminologies one at a time. All right. So let us first get into the definitions of financial instrument. So financial instrument is very broadly defined under IND AS 32. It is basically talking about any contract that gives rise to a financial asset of one entity and a financial liability or equity instrument of another entity. Can I request the admin to please take control of the lobby, because I'm being continuously notified whenever there are people that are admitted or not admitted at a time, and it's sort of acting as a disturbance. Thank you. All right. So coming back, financial instruments is a very broad explanation that they have given. Basically, they have not gone ahead and defined financial instruments in detail, but they have gone ahead and defined financial assets and financial liabilities in much detail that we will see over a period of time. So what IND AS 32 says in a very broad sense is that when there is any contract, now you may note that in this whole standard and in this whole presentation today, the importance of contract is very important. They have laid a lot of focus on what is a contractual liability, a contractual right, when the parties receive a contractual right to take money, to receive money, or to give money. All of these things are basically coming out of a contract. So I will also point out in the future instances, and even in IND AS 32, when they're defining financial instruments, they've said that any contract that gives rise to a financial asset of one entity and a financial liability of another entity is a financial instrument. So basically, say let us talk about this. There is a sale that is made, right? There is one party that has to pay money. There is one party that has to receive money. So one is a financial asset, one is a financial liability. This we're talking in a very layman's language, and that is how broadly defined financial instrument is. Trade receivables, payables, bank loans, overdrafts, issued debt, equity, preference shares, investment in securities, etc. are just some examples of financial instruments. Now we've seen what a financial instrument is. Let us spend some time in seeing what a financial asset is. And once you have the definition of financial asset clarified in your mind, I think the whole topic will get much easier. So as we can see, financial asset, a financial asset is any asset. Now please let us spend some attention over here. Any asset that is either cash, and by cash they don't literally mean hard cash, they also mean any bank balances, any FDs, any current maturities that are there. So a financial asset is any asset that is cash, an equity instrument of another entity. By another entity mean if we are Reliance Industries, its own equity will obviously not be a financial asset, right? That will be coming under equities. Whenever you hold an equity instrument of any other entity, that comes under a financial asset. And as I said in the definition of financial instrument, a contractual right. Now they have again emphasized on the word contractual over here. A contractual right to receive cash or another financial asset, right? Now let me assume that I have made a sale I've made a sale of oil, right? So I have made a sale of oil. Whatever is my trade receivable, which in our normal terminology we call as debtors, right? So with a debtor, what is the agreement? It is to generally receive cash, right? And that is how we were recognizing in the Indian gap so far. But what Ind AS goes ahead and says is that if you either receive cash or another financial asset from another entity, so it is not just limited to an amount receivable, it can also be an agreement where you receive another financial asset, which has to obviously satisfy the definition of financial asset that is given here. So that is there. That is one case where it can be a contractual right. Please look at that. I have highlighted the or. So you don't have to satisfy all three conditions. We just have to satisfy one condition out of these three. So to receive cash or another financial asset from another entity, or to exchange financial assets or financial liabilities with another entity under the conditions that are potentially favorable to the entity. The keywords over here are potentially favorable. What is an asset? Asset is something that is favorable. If you have to receive money from someone, that is a favorable outcome. If you have to pay someone, that is an unfavorable outcome. So similarly, Ind AS has gone ahead and they have even included where there is a contract where financial assets and liabilities are promised to be exchanged, right? In that exchange, when you may be giving a financial liability or a financial asset, the other person may also be giving the reciprocal of a financial asset or a financial liability. However, on the prima facie, the conditions should be favorable to you. If I am giving them a financial asset that has a book value of 1 crore, and if I'm receiving a financial liability of 80 lakh, then that is a potentially favorable outcome for the entity. However, if we go ahead and we see that I have to take an asset of 1 crore, but I have to give a liability of 1 crore 30 lakhs, then that is a potentially unfavorable outcome for me, and that will not classify as a financial asset, right? So a contractual right to receive cash or another financial asset, or to exchange financial assets or liabilities under conditions that are potentially favorable, or a contract that will or may be settled in entities' own equity instruments under circumstances. Now, there are certain circumstances where if there is a contract, if you can see, we have again talking about a contract over here. If there is a contract and that will be or may be settled in entities' own equity instruments. Now, entities' own equity instruments means where entity is issuing cash. What are these circumstances? We will see later in the while. I hope that this definition is very clear, because on the basis of the definition of financial asset and financial liability, the whole standard has been built. Now, some normal examples, if we have to talk about what are the examples of financial assets, if you have invested in equity instruments, your trade receivables, cash and cash equivalent, you have given loans, there are convertible bonds, security deposits have been given. Now, these are normal examples of financial assets. I don't think there is much to explain in this because everybody is aware that these are assets. However, if, as we can see on the previous slide, if they are satisfying these conditions, then they can be classified as a financial asset. So if you want to see how the balance sheet financial asset looks in a balance sheet, we have reproduced that on the next slide, where we are talking about how financial assets are reflecting in the balance sheet of Reliance Industries Limited in their annual report, that is for the year ended financial year March 2022. Now, if you can see, we have something called at amortized cost, at FVTPL, at FVT OCI. What is this? Please do not get panicked. We will cover later in the session. but I just kept this extract to see what are the assets that they have classified. So you can see they have classified investments. You can see they have classified trade receivables, cash and cash equivalents, loans, other financial assets. At FVTPL, again, there is investments and other financial assets. At FVT OCI, also there is investments and other financial assets. So how do we classify under any of these three? We will come to that later in the presentation. Anyone has any doubt in the definition of financial asset? If there is anyone, please unmute. Please feel free to ask, because then we'll go on to the financial liability definition. All right, I think we do not have any queries on that so far. So what we can do is we can go on to the financial liabilities definition then. Now, if you can see, a financial liability is basically a mirror image of a financial asset for obvious reasons. Here also we're talking about a contractual obligation. In financial assets, we were saying to receive cash on another financial asset. Here we are talking about to deliver cash on another financial asset. So whenever there is somebody that you have to pay or somebody that you have to give another financial asset to under a contractual obligation is a financial liability. Also, what is a financial liability is when you have to exchange financial assets or financial liabilities with another entity under conditions that are potentially unfavorable. In this case, if I have to receive 100 crores and I have to pay 130 crores, that exchange will be potentially unfavorable for me, and that will be classified as a financial liability. So if you can see the stark comparison in between a financial asset, at asset, we're talking about receiving cash on another financial asset. In a liability, we're talking about deliver cash on another financial asset. In financial assets, we're talking about conditions that are potentially favorable. In financial liabilities, we are talking about conditions that are potentially unfavorable, right? Also, what is a financial liability? Is a contract. Again, we are talking about contract that will or may be settled in entities' own equity instruments under certain circumstances. So what are these circumstances? Wherever entity has to issue its own equity instruments, we will see as we go later in the presentation. If we have to look at some examples of financial liabilities, it is debentures issued, loans taken, security deposit taken, trade payables, bill payables, outstanding expenses. Now, if you see, if you have taken a loan, you have to repay that. So you have to deliver cash. That is why it is a financial liability. Similarly, with trade payables, bill payables, outstanding expenses. Now, these are expenses that you have to, pay off, right? You have to pay in cash, or you have to give a financial asset to pay that off. So that is why that is also called as a financial liability. So what we can do is we can have a screenshot and we can look at the extract of financial liability from the Reliance Industries Limited annual report. Again, we're talking about at amortized cost, at FVTPL, at FVT OCI. As I said, we'll come back to that later, but let us see what they've classified. So they've put borrowing. Borrowings is money that they've taken on loan or other borrowing. Trade payables. Trade payables in our normal terminology, we call it as creditors. Lease liabilities is another thing that is there. And we have other financial liabilities. At FVTPL, we have other financial liabilities. At FVT OCI also, we have other financial liabilities. All right, I think everybody has seen that. I am believing everybody has properly understood what a financial asset or a financial liability is, because now going ahead we'll have to raise the technicality level a bit high. We'll have to talk about little more specifications, little more things that are a bit challenging to understand. that are a bit tricky in the Indian context because we've never thought this way. So that is why now we'll go on to the next slide where we're talking about equities. Now everybody knows what equity is. Everybody knows what equity shares are, right? So let me give a second for you all to read this through, and then we'll discuss on this. Yeah. So I hope everybody has this read through. So when we're talking about equity, as we everybody know, what do we call as our equity? What do we call as our net worth? Net worth or equity, as we call, is basically our assets, sum total of assets minus sum total of liabilities, and that is what we call as equity. In Ind AS also, equity has been defined as a residual interest in the asset of an entity after deducting all of its liabilities. Right? They've also gone ahead and added one more definition, which may be a bit confusing, but let us navigate together. Is that an equity is an instrument if and only if both below conditions are met. A, instrument includes no contractual obligation for the issuer. For the issuer means the company that we're talking about, to deliver cash on another financial asset to an entity, to exchange financial assets liabilities with another entity under potentially favorable conditions, unfavorable conditions. I'm sorry. So what they have basically done is that they have said that equity cannot and should not be a financial liability. Other than just being a residual interest in the assets of an entity after deducting all of its liabilities, equity should also be where it is not a financial liability at all. And there is another condition that they have kept, is that if the instrument will or may be settled in the issuer's own equity instrument, it is a non-derivative that includes no contractual obligation to deliver a variable number of its own equity shares, or a derivative that will be issued or settled only by the issuer exchanging a fixed amount of cash or another financial asset for a fixed number of its own equity instruments. Now I understand this B part is confusing. So later on, we've made a table to make that more clear for everyone. But for the time being, it is basically that what is an equity? First, it is a residual interest. Second, it should strictly not be a financial liability, right? So they have gone ahead and they have constructed the standard in a manner. They've given a broad definition of a financial instrument. Then they've given a detailed definition of financial asset, financial liability, and then they've given a residuary definition of equity, where anything that is not a financial liability and that is an interest, a residual interest in the asset of a company, that is then called as equity. Now, if we look at it, what are some examples of equity that are there, that you will see typically in any Ind AS balance sheet that you ever go through? There is equity share capital, there is share application money pending allotment, contracts that are pending to be settled in own equity instruments, putable instruments. Now, these are definitions that are these are examples of equity that we have, which we will see over the next few slides. Now, although it may, in our minds, we are very clear that equity cannot be a financial instrument. Financial instrument cannot be equity, for example, right? But let us still, because Ind AS has specifically asked to bifurcate in between liabilities and equity classifications, let us look at what are the key differentiators of what is a liability, financial liability, and what is an equity that can be classified. Why we are doing that is because so far in accounting standards or IGAAP, it has been very simple. Anything related to shares is equity. Everything other than that is liabilities. It can be current, non-current, or whatever. But financial instruments have, and especially Ind AS financial instruments, have recognized that you can also give equity to settle a liability. You can also give equity in exchange for any asset that you had to take. So that is why the definition or the clarity is important. Also, we will see later that there is something called compound instruments. So these instruments are basically, to say in a nutshell, they possess characteristics of both a financial liability as well as an equity, right? Convertible debentures, for example, right? So they are also carrying an interest rate, but at some point in time, they're also convertible. So they also have an equity portion. So that is why we are stressing on this point as to how do you differentiate in between equity, how do you differentiate in between liabilities. So as we can see, the critical feature, which I think I've said 5 times so far, is the existence of a contractual obligation, right? Uh, to deliver cash or another financial asset, which is something we have in a financial liability, but we do not have an equity. And the C part is to exchange financial asset or liabilities under conditions that are potentially unfavorable to the issuer. So, there was one point where I said that I have a table prepared. The point C is relating to that. Let us see the table when we're talking about this. Now, we have 3 scenarios that we have kept. In one scenario, the whole contract is about settlement of the contracted entity's own shares. What does that mean? If I have a company and I have entered into a contract with someone, at the end of fulfilling the contract, I have to issue equity shares, right? Now, you would say that this looks like an equity instrument only, but I am discharging a liability. And because I'm discharging a liability, there may be a possibility that this is a financial liability and not an equity instrument. So how that is classified? Now, there are 2 things that we have to see. First is the monetary value of consideration. Is the consideration fixed or not? We're talking about monetary value of consideration. Say, for example, we have something that we call a sweat equity, right? Now, sweat equity is where startups typically give equity shares to consultants in exchange for the time that they are putting in, right? So here, if let us carry this example. If it is fixed that, say, for example, the value of the services of the said person is 15 lakh rupees, right? So if that monetary value is fixed, however, the number of equity shares that I have said may vary. So that contract may say that, whatever is the valuation that may be existing on an XYZ date, we will issue shares on that date. So what happens is there is an uncertainty, right? What this exhibits is this is not typically an equity issue. This is basically settling a financial liability. So wherever monetary value of consideration is fixed, however, number of equity shares is variable, the classification is of a financial liability. Vice versa, if I say that I will issue 1,000 shares to a consultant, the number is fixed. However, what should be the value of shares? What is the monetary value of consideration? That has not been fixed. So we still call it as something that is variable. And in that case, it will again be classified as a financial liability. It will not be classified as a equity instrument. Now, however, when we're talking about that the monetary value of consideration is fixed and the number of equity shares is also fixed, my value is locked in, my number of shares is locked in. So basically, my valuation is also locked in. Only in that case can we say that the issue is an equity instrument. This bears importance for 2 reasons. First reason is that it shows a correct classification in your balance sheet wherever there are compound instruments or other contracts. It shows in a correct manner. And the second important is whenever we're talking about subsequent interest, dividend, losses, gains, valuation, fair value fluctuations. So if it is a financial liability, how do you recognize that interest, dividend, losses, and gains? If it is an equity instrument, how do you classify that? So that also is a conundrum that needs to be solved, and that is why we are spending time on liabilities versus equities to explain this point. Now, as I was talking about, we're talking about treatment of interest, dividend, losses, and gains. So classification of financial instruments as financial liability and equity, as we were seeing in the previous slide, they determine the related booking of dividend interest as income or expense in the P&L statement, right? So if it is if there is some dividend that has been there, if there is some interest that has been there, how do you book that is a question. And interest, dividends, losses, and gains relating to financial instrument or a component that is a financial liability, shall it be recognized as income or expense in profit and loss? So if it is a financial instrument, you know that it is going through a profit and loss account. If it is equity or a financial liability, how do you recognize that? And whenever there is distribution to the holder of an equity instrument, it shall be recognized by the entity directly in equity. So what we are trying to bifurcate by this medium is that whenever there is a financial liability, any income and expense goes in the profit and loss. Whenever there is an equity instrument, any distribution that has happened, it will be recognized directly in equity in other equities column. That is a special column that has been given under Schedule 3 of the Companies Act, which is the balance sheet on the P&L format under IND AS. Right. So that is why we were spending time to understand the difference between an equity and a financial liability, so that we can also recognize the income or expense that happens after that in the correct heading. Now, as I know that the session is a bit, content heavy, if anyone has any queries up to this point, we'll be more than happy to take it up. So if there is anyone with any queries whatsoever, please feel free to raise those. All right, I think either everybody has slept off post lunch, or probably either I'm too good where people do not have any queries, or I'm not able to explain at all and people are completely confused. I hope it is the former. Anyways, let us carry on with our presentation. I'll request all the participants, if at any point in time you have any questions that you need to raise, please feel free, and let us, if to the extent possible, let us try to break this theory topic into a discussion topic as much as it is possible. Right. Now, when we're talking about financial instruments, financial assets and financial liabilities, so what is important, as would have been explained by CA Dr. T.P. Anand, is that there is a recognition as to what is it recognized. Is it recognized as a financial instrument, financial liability, equity? What is the initial measurement? How do you measure the financial asset or financial liability? And then we talk about classification into the balance sheet and subsequent measurement. How do you measure that on every other reporting date? Now, giving a very, very layman's explanation to what I'm trying to say. If say I have a company that is into investments, right? And that company has invested into shares of say Adani Defense, for example, right? Or any Adani Enterprises company that is there. We have invested shares for the last 5-6 years. The shares have made tremendous gains. Say if I have bought in 2017, right? And after that, I have seen a lot of gains that have happened. So what is the first thing that you'll see is initial recognition, right? So initial recognition is first, is it a financial asset? Yes, it is a financial asset because it is equity instrument of another entity that we've held as a financial asset. Now, how do you recognize that financial asset? So whatever will be the cost of acquisition, add to that the brokerage and the STT that I have paid, that will be my cost. So that will become my initial recognition. And what is the classification? If I have, as I said, there is a fair value through P&L, fair value through OCI. Let us assume that for this discussion, it is fair value through profit and loss account only. When we're talking about fair value through P&L, how is it classified in the balance sheet and what is the subsequent measurement? So if I've bought in 2017 and the values have increased greatly in 2018, so that fair value, why we were saying in the beginning that IND AS has a lot to do with fair value and time value of money, is because they want you to recognize your assets and liabilities at fair value to give the reader or the user of the financial statements a much more realistic picture. If today anybody goes down to make a balance sheet for say Air India, for example, right, before it was taken over. Now Air India has taken land all over the country. They have they have quarters, they have land, they have assets. But in their balance sheet before, you were seeing all this being carried down only and only at cost price. Now you realize that the actual value of this land is much more. Now, although the land may not be typically a financial asset, what we are trying to say here is the idea of Indian accounting standards and IFRS when we talk about it globally is to ensure that the balance sheet is as uh, close to the reality as possible. Obviously, nobody can be perfect. There can be no specific value. Valuations change even from one valuer to another. But given those things, the idea is that whenever we're talking about a financial asset, in this case, if I'm talking about the shares of Adani Enterprises, right, they should be valued at the fair value, which is the market value that is there at the exchange on the closing date of the balance sheet. And there should be a continuous fair value evaluation so that whichever is the asset or liability that I have in my hand, that is showing at a very realistic value, and anybody that sees my balance sheet knows that as on 31st March, what was my company's actual valuation, what was my actual asset holding at that point in date. So that is what we are saying when we're talking about classification and subsequent measurement. Now, with this background, let me try to take you through initial recognition. Initial recognition is basically an entity should recognize a financial asset or a financial liability in its balance sheet when and only when the entity becomes party to the contractual provisions of the instrument and also classify the same according to measurement basis. So the first question is, when should I recognize? The idea is you should recognize it as soon as you become a party to the contractual provision. For example, I have bought the shares of a company A. As soon as I have bought that, the broker issues a contract note. When the broker issues a contract note, at that point in time, I have become a party. The shares have come to my account or my brokerage account. And when they've come to my brokerage account or demat holding, it has come into my balance sheet. So again, we'll have to see that they are emphasizing on the word contractual provision. Again, they are also saying when you become a party to the contract. Now, why they are saying that is because there should be a legal right that should be established or a legal obligation that should be established to either receive or pay money. Now, examples of initial recognition of arrangement as financial assets and financial liabilities is that unconditional receivables and payables are recognized as assets or liabilities when the entity becomes a party to the contract and as a consequence has a legal right to receive or a legal obligation to pay cash. Now let us break this down in our IGAP terminologies. I have made a sale. I have issued a sales invoice. The party has accepted the sale invoice, right? At this point in time, I have a receivable that is standing in my account because I have a legal right to receive the money. And the other person, when we talk about him, he has a legal right or he has a legal obligation to pay that amount of money because he has purchased goods and we are now his creditors that he has to pay. So this is the core concept that is there in mind. And when we talk about that, is when we're talking about initial recognition. So when should recognition happen? Is when party becomes a party, when the entity becomes a party to the contractual provision, right? Now, first example we took of receivables and payables. If we talk about the second example of issued debt, so issued debt is recognized as a liability when the entity that issues it becomes a party to again contractual terms of the debt and consequently has a legal obligation to pay cash to the debt holder, right? So if there is any debt that I have taken and we have contractually agreed that I will be repaying that amount of debt, when I have the legal obligation to pay that amount of cash, to the debt holder, at that incidence exactly is when we will initially recognize it. Now, I believe this is very clear as to when we will recognize. What is the amount that we will recognize is something that we will now see under initial measurement. So IND AS 109 requires that a financial asset, except for certain trade receivables, or a financial liability should be measured at initial recognition at its fair value plus or minus for financial assets or financial assets not subsequently measured at FVTPL, transaction costs that are directly attributable to the acquisition or issue of financial asset or financial liability. Without getting into FVTPL or FVTOCI in detail, what we can do is, I think this is a good time to mention that when we open any profit and loss account of an entity that is preparing its financial statements under IND AS, we would see that there is something called your normal profit and loss account, and we write profit before other comprehensive income, and then there is something that is called as other comprehensive income that is below all your normal revenues, normal sales, and all your normal expenses, even below your tax provisions or tax effects that need to be given. Now, what is this other comprehensive income? If I have to talk about it in a very vague manner for everybody's understanding, your profit and loss is income that you are receiving from your business activities, from activities that are core to your business. What is other comprehensive income is something that is not core to your business, something that may or may not recur. There is a difference in between an extraordinary income that we classify under IGAP and other comprehensive income that we classify under IND AS. So what IND AS believes is there is nothing extraordinary. There is nothing that is done outside the business. If you're running a business, any income you receive, any expense that you receive is a business expense. So IND AS has done away with the concept of extraordinary incomes or expenses, but they have brought in a concept of other comprehensive income. Why they have specifically separated other comprehensive income is that anybody that is reading the profit and loss account should understand what is income from my core business activities, regular income, income that I expect to repeat over time, and what is other comprehensive income, which is income of the company, but this is not my core activity. This is not something that is essential for my business, and that is shown as a net income or an expense under other comprehensive income. After the session, if you want, I can even project how that looks like, right? So that is why we are continuously talking about fair value through profit and loss, fair value through OCI, which is other comprehensive income, is because under IND AS and under IND AS 32, 107, 109, we are talking about how you can take the fair value and route it through your normal profit and loss account or route it through your other comprehensive income. At the end of the day, it is just a presentation change. But for IND AS, that is significant because they want all readers of financial instruments to take informed decisions whenever they want to analyze a profit and loss and realize what is core, what is non-core. So I just thought that we'll probably just put it or clear it out of the way rather than all of you all carrying the doubt as to what is OCI, what is FVTPL in this case. Now, we are talking about initial measurement. So how do you measure a financial asset or a financial liability? So as it is seen, any amount that is a fair value. Why they're talking about fair value and not strictly cash is because they believe there may be instances where there may not be an exchange of cash. As we were seeing, there may be an exchange of financial assets or liabilities for conditions that are potentially favorable or unfavorable, right? So in those cases, you cannot talk about a specific amount. You can talk about fair values. So that is why they're talking about that a financial asset or a liability should be measured at initial recognition at its fair value plus or minus the transaction costs that are directly attributable to the acquisition. Now, as we saw in the earlier incidents, if I have taken a share, what will be my transaction cost if I have bought a share of Adani Enterprises, for example? The transaction cost will be whatever I've paid as brokerage, whatever I've paid as STT, or any other duties that are levied. As it is written here, transaction costs are defined as incremental costs that are directly attributable to the acquisition, issue, or disposal of a financial asset or financial liability. An incremental cost is one that would not have been incurred if the entity had not acquired, issued, or disposed of the financial instrument. What it is basically trying to say is that transaction costs should be directly related to acquisition, in this case, say, of the shares that I'm talking about. Would I have incurred the brokerage had I not bought those shares? No, I wouldn't have. So that is why that is something that is only an incremental cost that is directly attributable, and that is why it is defined as a transactional cost. Now, let us just read through this. Is that for debt instruments that are subsequently measured at amortized cost or FPT OCI, transaction costs are included in the calculation of effective interest rate. So effective interest rate, as I'm been talking about, that IND AS is talking a lot about time value of money, is that they have asked companies to use effective interest rate at a lot of instances, especially in financial instruments. So what they are trying to say is that let us, later when we go in detail in amortized cost, we can revisit this slide. But for now, what they are trying to say is that if there is any debt instruments that is measured at amortized cost or fair value through other comprehensive income, transaction costs are included in the calculation of effective interest rate. So there is a discounting rate that is calculated specifically, and that discounting rate will include these costs, and in effect, they are amortized through profit and loss over a term of the instrument. Hypothetically, if the effective interest rate is 4.5%, so because of that 4.5% of EIR and discounting, every year it will bear an effect of the transaction cost that was incurred. Now, for investments in equity instruments, the above that we were seeing was debt instruments. Now, for investments in equity instruments designated as FPT OCI, which is fair value through other comprehensive income, the transaction costs remain in equity and are not subsequently reclassified to profit and loss account. So, as we were talking about, say for example, in this case, as we were talking about shares of Adani Enterprises, in this case, we realize that they will be attributable to equity, they will be added to the cost, and they do not interfere with the profit and loss, which is basically what we were doing in Accounting Standard 13 also till date. For financial instruments classified as fair value through P&L, transaction costs are recognized in profit or loss immediately on initial recognition. So if it is fair value through P&L, transaction costs are immediately recognized in either profit or loss, right? How do we do that? What is FVTPL, FVT-OCI, amortized cost? Will come on probably in the next slide itself. All right. Here again, because now also the content will get a bit heavy, bit technical. I would request if anybody has any queries whatsoever, please genuinely feel free to ask, because for the next some time, for the next 5 to 10 slides, we will get a bit more technical. I am taking this leverage of going technical because I believe that this is important, and although this may be boring on an afternoon to listen to, but I believe even if you've gotten a very over the top hang of this concept, I believe it will help you to a great extent in understanding financial instruments. So anyone, if there is any query whatsoever, please feel free to ask. All right. I think the session is actually where people are sleeping probably. That's why there's no query on a topic that I believe is a bit hands-on and more difficult. So let us carry on. Let us get into now. Let us now get our what we call hands completely full of what we're talking about as a financial asset, what we're talking about as a financial liability. And in this case,
what you've been hearing over the last 1 hour about what is an amortized cost, what is fair value through other comprehensive income, what is fair value through profit and loss. Let us now get into details. Let us now get into understanding how it is decided, what is the assessments that need to be made, right? So I believe everybody is with me, and I hope everybody stays with me for the next half an hour, because this is a very crucial element of financial instruments that needs to be understood. So now we're strictly talking about financial assets. We're not talking about financial liabilities at all. Till now, we were talking about financial assets and liabilities, their initial recognition and everything. At this juncture, we are completely and only talking about financial assets. There is no conversation about financial liability. And we're talking about subsequent measurement. So far, we've seen what is the initial measurement, initial recognition. Now we're talking about how do we classify it, and how subsequent to initial recognition, how do you measure it, right? So under IND AS 109, financial assets are classified according to the measurement basis. How you measure the asset is how you classify it. As you had seen in Reliance Industries extract of annual report, there was something that was amortized, classified under amortized cost, something under FVT OCI, which is fair value through other comprehensive income, and something under fair value through profit and loss. So that is being specified in this case. So subsequent to initial recognition, the financial assets are measured at amortized cost. It can be either amortized cost, either FVT OCI, or either FVT PL. Now, investment in equity instruments are required to be measured at FVT PL, except that investment in equity instruments meeting certain criteria may be irrevocably designated as FVT OCI on initial recognition. Fair enough. What it is saying in a nutshell is that wherever I have recognized equity instruments as an investment, it should be done on FVTPL, except in certain cases. I hope everybody will get used to me using the short form of FVTPL and FVTOCI for brevity. Now, how do you see if it is amortized cost? What is FVTOCI? What is fair value through P&L? There are two assessments or tests that we need to undertake to classify it under either amortized cost, FVTOCI, or FVTPL. Now, what is this test, right? The test is basically, first, we have to test the business model of the entity, and then we have to test the cash flow of the financial asset. Now, before we go into detail, what is the business model? What is the contractual cash flow is something that we will need to probably understand, right? So as we can see, except for financial assets that are designated at initial recognition as FVTPL, the classification of a financial asset is based on entity's business model for managing the financial asset and contractual cash flow characteristics of the financial asset. Now, what does this mean? The first, when we're talking about, is the business model assessment. So we have to see what is the business model of the company. Is the business model mainly into investing into shares or investing into instruments and receiving interest on it, receiving gains on it? Is that the business model? Or that the company is into something else, but because it saw an opportunity for gains, it has bought those shares. So this is what basically is we have to assess when we're talking about our business model assessment. In the business model assessment, we have to see what is the contractual cash flow, which is the second point, is the contractual cash flow characteristics of the financial asset. So what is the business model assessment? So first we have to see is, does the business model of a company, does it have to hold assets to collect contractual cash flows? Say, for example, I have held an asset. I have, say, invested in debentures, right? And my only idea is that I will collect interest on the debentures that I have invested in. I have invested in 81 bonds, or if I have invested in some instrument as such, where my objective is purely to hold the asset to collect the contractual cash flow, right? So the first part is we have to see, is the business model to hold assets to collect contractual cash flows? Financial assets that are held with a business model whose objective is to hold assets in order to collect contractual cash flows are managed to realize cash flows by collecting contractual payments over the life of the instrument. So whatever is the life of the debenture, I am just holding it to collect that amount of interest. Now, what does this mean is the entity manages the assets held within the portfolio to collect those particular contractual cash flows only. Now, this can be one business model. The second business model can be that I can hold it to collect contractual cash flows as well as to sell it. It is not necessary for me to hold on to an asset throughout my life. If I feel I'm getting a good value, right, my business model can be to collect cash flows till I feel it is right, and to sell the asset, financial asset, whenever I feel that is correct. Which is the second point here that we are talking about, is that is the business model to collect contractual cash flows and sell it. Now, there are various objectives that may be consistent with this type of business models. For example, the objective of the business model may be to manage everyday liquidity needs, to maintain a particular interest yield profile, or to match the duration of financial assets to the duration of financial liabilities that those assets are funding. To achieve such an object, the entity will both collect contractual cash flows as well as sell financial assets. What is an example of this? Is that in the normal course of business, trade receivables are held only for recovery of contractual cash flows. Hence, trade receivables are measured at amortized cost basis or an actual cost basis. What they are trying to say is that if, for example, I have a trade receivable, I will try to match the trade receivable time with my trade payable time so as to meet my everyday liquidity needs, right? So I am not just holding them to collect interest. I am not just holding them to collect interest for the life that it is there. These are normally done to maintain my everyday liquidity needs. Now, second is, when you compare to a business model whose objective is to hold financial assets to collect contractual cash flows, this business model will typically involve greater frequency and value of sales. That is because selling financial assets is integral to achieving the business model objective instead of being only incidental to it. However, there is no threshold for frequency or value or sales that must incur in the business model, both collecting contractual cash flows and selling financial assets. Now, let us see an example. Investments in shares or other debt securities for mutual fund companies are held for collection as well as selling. Hence, they are measured at FVT OCI. So what we're talking about here is typically what we were speaking about in the previous slide is that the business model of a company A can be to hold assets to collect contractual cash flows. The business model of a company can also be B, where it is holding assets to collect contractual cash flows and to sell it off. Now, trade receivables, for example, trade receivables are, it is basically collecting contractual cash flow to pay ahead, right? And when we're talking about, say, in the second example, that, the business model is to hold financial assets and it involves greater frequency and value of sales. If it is a mutual fund company, right? It will invest in shares, it will sell in shares. It will invest in debt instruments, it will sell those debt instruments. Now, this is something that they keep on doing. You cannot specifically say that, if you have done it twice in a year, the frequency is high. If you've done it more than that, the frequency is low. There is no specific threshold. But what we're trying to say is that the first assessment that needs to be made for classifying a financial asset should be the business model assessment. And here you have to see, as I said before, is A, have you kept the financial asset to collect only contractual cash flows, or have you kept it to collect contractual cash flows as well as sell it off, right? Now, this is business model assessment, or what we call, this is test number 1. Test number 2 is contractual cash flows characteristic test. Now, we're talking about contractual cash flows. Again, as I said before, this standard refers to everything into a contractual basis. That's why we are not simply talking about cash flow, but contractual cash flow. Right? So, the second test that needs to be done, the first one that will always be done will be the business model assessment as to what is the company's model. and then there'll be a smaller test done that will be a contractual cash flow characteristics test. So an investment is considered to fulfill the contractual cash flow characteristic test if its cash flow, and by cash flow we are always meaning principal and interest both, is in line with a basic lending arrangement. A basic lending arrangement, what is a basic lending arrangement? If you have gone to someone and you have requested for money and he's asked interest in return of in addition to the principal, what does he look to be compensated for? First, he'll look to be compensated for inflation, which is the time value, which is how much time has passed. If it is 1% and now the interest rates are rising where home loan interest rates are more than 9%, so has that been taken into account? The credit risk is basically if say you are, for example, Reliance Industries, which has a net debt zero balance sheet, right? People will be more than happy to give money to them at a very lower interest rate. But companies, say for example, like Adani, because that is highly leveraged, companies will find a higher credit risk. So that is a basic lending ideation that needs to be done, and the basic lending arrangement is compensating for inflation, credit risk profile, and reasonable profit margin. Now, this is what we're talking about, contractual cash flow test, that is principal and interest. Now, other than this, if there is any other compensation that is linked to an inflation rate, RBI rate, credit rating, then the CCFC test is satisfied as a lender in a basic lending arrangement where it expects to be compensated for time value or credit risk, right? Apart from the above, charges levied by the lender like processing fees, prepayment penalties are also considered to be in line with basic lending. So what is the idea of this slide and what is it that we're trying to do is we are seeing if it is a basic lending arrangement that has been done or if it is something else, right? So where is it a basic lending arrangement? Is where you're paying someone, not just the principal, but with interest, and that interest is compensating for inflation, credit risk, reasonable profit margin, and it is taking into account processing fees, prepayment penalties, and other basic items that are considered, then it is considered to be, a basic lending thing. Now, there are also special cases where there is a trade receivable and loans repayable on demand. If you know a seller does not expect interest on a credit sale during the credit period, and a depositor in current account does not expect interest in ordinary course in a basic credit sale or deposit arrangement. However, they expect solely return of principal, and hence the CCFC test is met as the principal is contractually agreed to be returned, right? So not what we are trying to now determine is in the first business model assessment, we were seeing that is the business model to collect cash flows purely or is it to collect cash flows and sell, correct? Now, when we're talking about the contractual cash flows characteristic test, we're seeing is it purely somewhere where they want to receive just the principal? Is it purely somewhere where they just want to receive principal and interest both? Wherever it is principal and interest and basic lending terms are agreed, that is a separate case. And whenever we're talking about receiving just the principal, now if you have made sales on goods, right, and you have given your buyer a 1 month credit period, are you expecting any interest on that credit period? No, right? When we are not expecting any interest on the credit period, then it cannot be considered to be a basic lending agreement. What you are expecting here completely is just your return of principal that has been agreed upon. Now, these were the two things that we were talking about. Was one, business model assessment, and second, contractual cash flow test. Now, these are two tests or two measurement criteria that we need to see. Before we finalize, is it an amortized cost? Is it fair value through OCI? Or is it fair value through P&L? So whenever we are doing any analysis on any financial asset whatsoever, we have to ensure that these two tests are performed before we can classify, which is you have to see the business model and you have to see your contractual cash flows characteristics test. Now coming down to specifics, what comes at amortized cost, what comes at FPT OCI, what comes at FPT PL. Now these are things that we want to see, right? So I hope everybody is with me till now. Now, whenever we're talking about amortized cost measurement, right? Two conditions need to be satisfied to measure a financial asset and amortized cost. One, the assets must be held in a business model whose objective is to collect contractual cash flows, right? Which is the business model test that we were talking about, right? Is that the business model should be to collect contractual cash flows only. We are not talking about realizing fair value through sale. And which is basically both these conditions need to be met, is that the contractual cash flows are solely payments of principal and interest on principal, where interest is the compensation for time value of money and credit risk. In basic terms, if I have to speak in a very layman's language without being completely correct, amortized cost is generally done for debt instruments and other instruments, wherever you are receiving contractual cash flows, you don't want a fair value realization through sale, and you are receiving principal and interest on principal, right? Now, because both these conditions are met, the business model test and contractual cash flow test, it would be an amortized cost measurement. Now, the order in which these tests are performed is not relevant. However, in practice, it is likely that business model test will be considered first because it is performed at a higher level. Whenever I have to do a test for an asset, I will first see what the business model is, because the business model is supposed to be consistent for a larger number of assets rather than a contractual cash flow test. So when we are meeting both these criteria, we can recognize it as an amortized cost. I have made a flow chart later also for everybody, a yes and no chart for everybody to understand what is an amortized cost, what is a fair value through OCI, and what is a fair value through P&L. Now I'm leaving this slide on for 15 seconds. I hope everybody can just read through this, because the next two FET OCI and FET PL will be depending on what we've just said. All right. Now, what is at an amortized cost? We've just seen. Whenever there is a business model test, collect only contractual cash flows and not to sell. And whenever we're talking about the contractual cash flows test, it is about interest plus principal that we're talking about. All right. Now, a financial asset should be measured at FET OCI if both of the following conditions are met. First one is if the asset is held in a business model in which assets are managed both in order to collect contractual cash flows and for sale. So the and for sale is basically the distinguishing factor in between an amortized cost and an FET OCI. A trade receivable is not held for sale, but an asset, an equity asset, an equity investment that you have made, that can be held for sale. So this is a very basic difference in between amortized cost and OCI. The second condition that should be met for FET OCI is that the contractual terms of the financial asset give rise on specified dates to cash flows that are solely payments of principal and interest on principal amount outstanding. So what we are saying here is that in an amortized cost and as well as in fair value through OCI, there is a specific contractual liability of the other entity to give us payment of principal and or interest, and I have held those financial assets specifically to receive these contractual cash flows. For amortized cost, it is only contractual cash flows that I have held it for. For fair value through OCI, it can be contractual cash flows as well as sale. So this is the distinguishing factor in between amortized cost, what goes as my amortized cost and what goes as my fair value through OCI. Now, this is something that cannot be very easily generalized. It depends from company to company. It depends from business model to business model. It depends, At one point in time, a company may hold an asset purely for the purposes of sale. At one point, they may purely hold it not for the purpose of sale. So it's a very continuous evaluation, subsequent measurement that needs to be done over every financial reporting period or over the end of every financial year, where this needs to be made. Now we've seen what an amortized cost criteria is. Now we've seen what a criteria for measurement at fair value through OCI is. Naturally, whatever is not an amortized cost in FVT OCI will be something that will be a fair value through P&L. But still, let us read through one. So as explained, any financial asset that does not qualify for amortized cost or measurement at FVT OCI must be measured subsequent to initial recognition at fair value through P&L, except in case of an investment in an equity instrument irrevocably designed as at FVT OCI. This is a specific scenario. We will not get into the details of that because it may be confusing, but we can, for our understanding, learn that whatever does not qualify for amortized cost or fair value through OCI will be taken in the measurement at fair value through P&L. In addition, financial assets that are held for trading or designated at initial recognition as FVTPL must be measured subsequent to initial recognition at FVTPL. So as we said, whenever there is anything that is specifically held for trading, right, that is always considered as fair value through P&L. Now the next slide that we have is a proper chart. That is a yes and no chart that is summarize whatever we have done so far. Again, I will give a minute for everybody to read this once, right? To read how this is constructed, how initial recognition happens, how initial measurement happens. Because once you have cracked the initial measurement, then we can easily crack the subsequent measurement, so on and so forth. So I would request everyone to just once, give this chart a read on your own, and within a minute, I will then join you and we will go through this chart again together. All right. So let us take this chart through. So when we go to see, in the first point that we're seeing here, right, are the contractual cash flows solely payments of principal and interest on the principal outstanding? If that answer is yes, is the financial asset held with a business model whose objective is to hold financial assets to collect contractual cash flows? Say the business model is to hold, collect, or contractual cash flows. At initial recognition, is the financial asset irrevocably designated at FVTPL, or doing so eliminates or significantly reduces the measurement or recognition inconsistency? Now, this is something basically that they're saying that in the initial recognition, have we understood that it is held completely for the purposes of trade, which recognizes is at FVTPL? If yes, then we call this as fair value through P&L, right? If no, then it goes as amortized cost. Why does it go as amortized cost? Basically, is the idea is to hold financial assets to collect contractual cash flows. It does not hold financial assets for selling, right? So when it only holds contractual cash, when it holds assets only for collecting contractual cash flows, it is always amortized cost unless and until it is held specifically for trading. Now, let us look at the next scenario. Contractual cash flows, solely payments of interest of principal and interest on principal outstanding, yes. Is the financial asset held with a business model whose objective is to hold assets to collect contractual cash flows? If it is yes, it is amortized cost. But if it is no, then we have to check, is the financial asset held with a business model whose objective is achieved both by collecting cash flows as well as selling financial assets, right? If it is yes, as we had seen before, then it is FVT OCI. If it is no in this case, then it is FVT PL, right? Now, let us look at case number 3 that is possible. Are the contractual cash flows solely payments of principal and interest on principal? No, it's not solely. So the contractual cash flow characteristics test has not been fulfilled. Because that has not been fulfilled, is the financial asset held asset a non-held for trading instrument in an equity instrument that is irrevocably designated as FVT OCI at initial recognition? This is another tricky terminology that we're not going into detail, but simply if I have to put it, is it an instrument that initially was not recognized irrevocably as fair value through OCI? If no, then it is a fair value through P&L again. Now, in a case where principal and interest payments, outstanding cash flows condition is met, cash flows and selling financial conditions is met, it has not been designated as FVTPL permanently, has been met. If all these conditions have been met, then it is FVT OCI. Now, in theory, there are multiples if and or, but however, if we don't go into that much of theory, we realize that as we had seen in those slides easily, is that everything can be easily understood basically by your business model assessment and your cash flow test assessment that is there. All right. Now, coming on to subsequent measurement, as usual, before subsequent measurement, I will ask if there is anybody that has any doubts that wants to ask something at this point in time. Please feel free to.
Hello.
Yes.
Yes, sir. I have one doubt regarding the trade receivables.
Yes.
Do we have to classify them under the amortization, this thing always, or if there is a case when the company has a regular practice of say discounting 100% of its trade receivables or passing it over to somebody else through some other arrangements, so
Yeah.
can it be held as an arrangement for sell?
Okay.
What kind
Good.
of model?
I think that is a very good question. Now, again, in amortized cost, there is how we define how amortized cost will come on to the subsequent measurement. It is right in the next slide, is where we're talking about any principal repayment or any payments that have been made or whatever is the outstanding of any financial asset under amortized cost. It requires to be applied the effective interest method. As we've been speaking about time value of money, so there will be a time value of money that we will have to apply to it. Now, why I'm saying this specifically is because if we have entered into a financing arrangement where we have, say, discounted our trade receivables, if I understand correctly, that is the question, right? So if
Yes, sir.
we have
Yes.
done that already, that means there is a preset rate at which we have discounted them, right? Because
Yes.
we have done that already, we will have to take it under effective interest method, and we will have to show it at a value which is not considered as the finance cost, which is purely just the trade receivable amount. Whatever we have discounted it at will be known as the finance cost in this specific case. So if, for example, I have discounted my receivables at 3%, right? And it may be a case of full factoring or factoring without recourse, with recourse. There are different ways in which we do it, but let us assume it has been done at 3%. So that 3% I would recognize as a finance cost, and the 97% will be recognized as a financial asset. Now, this is without knowing what time it has happened and everything. But what I'm just trying to say or give an overview, what we'll also see in the next slide in this case is why it will go under effective interest rate, because there is a finance or an effective rate that we can calculate. I am hoping that is answering the question.
Yes, sir. Thank you. Thanks a lot.
All right. Thank you so much. All right, if there are no further questions, we'll go on to the next slide. Now we've talked about initial measurement. What is initial measurement is how it will be recognized the first time. What is subsequent measurement is as literally as it goes, what it is recognized after the first time it has been recognized at, however it has been calculated and classified. When we're talking about to amortized cost, as we can see, the amortized cost category applies only to debt instrument financial assets that meet the specified criteria. By specified criteria, we're meaning both the business model test and the cash flows characteristics test. Amortized cost measurement requires the application of effective interest method. So whatever is the effective interest rate that is calculated, it needs to be discounted at that value, and that is recognized as effective interest method. A very layman example of this also of effective interest rate method is, say for example, you have the company has taken an office on rent. The company has given a deposit, right? Say they've given a deposit of 5 lakh rupees for taking an office on rent. Now the term of contract for the office is the leave and license for it is of 3 years. So it means that the company will receive his 5 lakhs after 3 years. Correct. Now, over a period of 3 years, the value of 5 lakhs will depreciate. In normal accounting standards, we would have shown it as an asset, non-current asset, for 3 years at a stretch. Right? But in financial instruments, in IND AS, we will have to show it on amortized cost. We will have to find out the effective interest rate, and that effective interest rate based on company's assumptions and company's factors, based on those rates, it will be discounted. Once it is discounted, we have to realize that today, for example, the 5 lakhs may be recognized at 4,25,000. Next year it will become 4,50,000. The next year it will become 4,75,000, and on maturity it will become 5 lakhs. So although it is not simple interest rate, but for the sake of simplicity, if it is simplicity, that 25,000 that is added every year is basically the finance cost that we are talking about, which we have to discount and which we have to consider every single time, so that it shows a realistic picture that what is the actual value that we will receive at that point in time. That is why the first line of this slide says that the amortized cost category, it applies mainly to debt instrument financial assets, right? So this, as I said, is a type of a debt instrument. Amortized cost of a financial instrument is defined as the amount at which the financial asset or financial liability is measured at initial recognition minus the principal repayment plus or minus cumulative amortization using effective interest method of any difference between the initial amount and the maturity amount, and for financial assets adjusted for any loss allowances. Right? Now, gains and losses resulting from fluctuations in fair value are not recognized for financial assets classified in the amortized cost measurement category. Any fair value changes will be recognized only when they have been recognized as under FET OCI or FET PL. There will be no fair value fluctuation that will be recorded on a every reporting year basis when we're talking about amortized cost. Now, when we talk about fair value through OCI, investments in particular equity instruments that may be irrevocably designated an initial recognition as an FET OCI, if this election is made, only dividend income that does not clearly represent a recovery of part of the cost of the investment is recognized in profit and loss with all other gains and losses recognized in OCI. What they are trying to say is that when there are particular instruments that have been irrevocably designated at initial recognition as FVT OCI. Now, there is one concept in IND AS that I think should be introduced at this point, is that there are certain cases where any asset can be reclassified from an FVT OCI to an FVT PL. So when we are talking about that, the whole accounting changes. We do not want to go into the details of that because that will be very confusing at this point in time. But what it is trying to say is that if there is any financial asset, which is basically investment in particular equity instruments that have been irrevocably designated as FVT OCI, which means later they cannot be subsequently recognized as FVTPL. So whenever this election is made, only dividend income that does not clearly represent a recovery of the cost is recognized in profit or loss, with all other gains and losses recognized in OCI. So whenever there is any fair value changes, whenever there is any interest that is received, whenever there is any dividend that is received, that will be classified under other comprehensive income, not under P&L, except probably a case where you cannot clearly state that the dividend income has been received purely for recovering the cost of the investment. Now, this was for particular equity instruments. When we're talking about particular debt instruments, which were measured at FVT OCI, for these changes in fair value should be recognized in OCI, which is basically other comprehensive income, except for interest calculated using EIR, foreign exchange gains and losses, impairment gains and losses, until the financial is de-recognized or reclassified. By basically reclassified, we mean classified as a under FVTPL. So these are talking about the exception. Now let us talk about what is the normal trend. So in subsequent measurement, it is very simple. If I have shares in my portfolio to the value of 15 lakhs today, and if as on 31st March 2024, the value is 21 lakhs, I will simply show rupees 6 lakhs and the after tax effect, if any, on that 6 lakhs as fair value through OCI, and the asset in my balance sheet will be lying at 21 lakhs. So if we have to recap a little, under amortized cost, there is only using effective interest rate method. There is no fluctuations for fair value. Under FVT OCI, other than the three exceptions that we can see on screen, other than these exceptions, everything will have a fair value measurement as on the reporting date, and that fair value will be considered, will be recognized in other comprehensive income, not under P&L. It will be recognized under other comprehensive income, and it will be shown, and the asset will be increased or decreased to meet the fair value to that extent, right? And then we see what happens at FVTPL. Assets classified as at FVTPL are measured at fair value. Gains and losses that arise as a result of changes in fair value are recognized in profit and loss. In a case where we were recognizing under other comprehensive income for assets that were held under FVT OCI, we will be recognizing under profit and loss for assets that are held in FVTPL, except for those arising on hedging instruments that are designated in effective cash flow hedges or hedges of net investments in foreign operations. This is another small exception to the fact. Also, gains and losses that arise between the end of the last reporting period and the date an instrument is de-recognized do not constitute a separate profit or loss or disposal. Such gains and losses will have arisen prior to the disposal while the item is still being measured at FVTPL and should be recognized in profit or loss when they occur. What the second point is trying to say is that if I have held some amount of share, and if there is some year where we have sold it off, so it will not show separately as a line item that the profit and loss on a financial asset that has been disposed of or been sold off. What it will say specifically that this is a profit and loss that is recognized in the normal circumstances, and it will come under normal FVTPL criteria and categorization only. So when we were talking about financial assets, if we take a very quick recap of that, we've talked about in the last half an hour, we've talked about financial assets We've talked about classification. We've talked about the business model assessment and the cumulative cash flow test that needs to be done to be realized if it is happening at amortized cost, if we think it is happening at fair value through OCI, if we think it is happening at fair value through P&L. And under all these three cases, what are the subsequent measurements? How do you show it under profit and loss account as of every year end? So this is what we've seen briefly over the last half an hour. Now we have done a financial asset classification and subsequent measurement. Now we have to do that similarly for financial liabilities. The good part is that for liabilities, it is much more precise. It is much more easier as compared to a financial asset. So let us go through that. All other liabilities are required to be classified and subsequently measured at amortized cost, except for the following. Basically, what they are trying to say is that assets can be held under different asset models, cash flow characteristic tests, business models, etc. When it comes to liabilities, other than these 6 specific cases mentioned, everything that is held at amortized cost. And everything that is held at an amortized cost is then discounted, or a finance cost is given effect using your effective interest rate. Now, what are the exceptions? First is derivatives, unless hedge accounting applies. By hedge accounting, it's a separate accounting format that applies. Held for trading liabilities, for example, securities that are short sold. So in a share market that we have a short selling that is done. So that is basically a liability that is held for trading, right? It is not a confirmed liability. Liabilities designated at fair value through P&L. On the next slide, we'll see that there are certain liabilities that we designate specifically as fair value through P&L. Financial guarantees. Now, if our company has given a guarantee for a sister concern, the financial guarantee, the value of financial guarantee will not be coming at amortized cost, but through fair value. The last two are very specific cases is contingent consideration on account of business combination. Business combinations mean generally, amalgamations, mergers, so on and so forth. So whatever is a contingent consideration that is not contractually defined, will not be measured at amortized cost, but will be taken elsewhere. And continuing involvement approach in case of recourse factoring of trade receivables. So as we were talking about trade receivables before, now continuing involvement approach is a separate approach, and recourse factoring, I'm sure everybody will be aware that factoring can be with recourse or without recourse. So in this very specific case, where there is continuing involvement approach, in case of recourse factoring of trade receivables, it will not be taken at amortized cost, but it will be taken elsewhere. So to recap, all other liabilities are required to be classified and subsequently measured at amortized cost, and then obviously using your effective interest rate method, except derivatives held for trading liabilities, liabilities designated as FVTPL, financial guarantees, contingent consideration on account of business combination, and continuing involvement approach in case of recourse factoring of trade receivables. Now, financial liability at fair value through P&L. This category can be further divided into 2 subcategories. Financial liabilities classified as held for trading. Financial liabilities designated by the entity as FVTPL. Now, this is an option. The second one, if you're talking about, is an option available in very limited circumstances. The designation is irrevocable, so that once made, the liability cannot be subsequently reclassified into another category during its life. So these are specific instances and specific cases that we cannot go through now due to paucity of time. But if you can see from the above, held for trading liabilities and liabilities designated at FVTPL will be financial liabilities that we will recognize at fair value through P&L. So reclassification of financial liabilities, into and out of FVTPL category are prohibited. The following changes in circumstances are not reclassifications. As we had seen in the previous slide, whenever a choice in FVTPL is made, that is an irrevocable choice. However, the following two are not changes in are changes in circumstances and they are not reclassifications. Is that if there was a derivative that was previously designated an effective hedging instrument in a cash flow hedge or a net investment hedge, no longer qualifies as such, and a derivative instrument becomes a designated and effective hedging instrument in a cash flow hedge or a net investment hedge. These are very specific criteria where if there is any circumstances change, that will not be taken or counted as reclassification. All right. So with this, we have completed financial assets. Financial assets was the tricky part. Then we've come down to financial liabilities. Now we'll go to a last, very last topic that I want to touch base on. Looking at the clock, I will not take very long on that. Is what are compound instruments? So compound instruments we will touch base upon, and then we will close for the day. So basically, the terms of a financial instrument that may be structured that it contains both equity and liability components. That is, instruments is neither entirely a liability or nor entirely an equity instrument. Such instruments are defined as compound instruments. An example, as we have said before, an example of a compound interest is a bond that is convertible either mandatorily or at the option of the holder into a fixed number of equity shares of the issuer. Compound instruments come in many forms and are not restricted solely to convertible instruments. There are many other examples of compound instruments. Nowadays, a lot of large corporates and startups also issue a lot of compound instruments. So the simplest example that we can take is a convertible bond. The liability and equity components of a convertible of a compound instrument are required to be accounted separately. How they will be recognized separately is something that we'll see in the next slide. So the method that we use basically for separation of the instrument into liability and equity components is made upon initial recognition and it is not subsequently revised. So the method is that first we will take the fair value of the liability component, and this fair value establishes the initial carrying amount of the liability component. Initial carrying amount is basically what you will recognize had it purely been a liability. Secondly, the fair value of the liability component is deducted from the fair value of the instrument as a whole, with the resulting residual amount being recognized as the equity component. Now, let me not use wordings, but an example for this. If there is a convertible debenture that is there, right? So if there is a convertible debenture that has been issued, say we have issued because it has an equity component, right? The value of it will never be same to the value of how it would have been had it been purely a non-convertible debenture. Now, whatever is the fair value, first we will estimate that if this would have been only and purely a liability, what would have been the fair value of that instrument today? Then I would go on and estimate. We would ask a valuer. The estimate of this is generally done by registered valuers only. We will go and ask what is the value for the whole instrument, which is basically the compound instrument that has the convertible clause. There are specific methods by which that valuation is done. And once that valuation is achieved, we would subtract the pure liability component valuation, and whatever is the resulting residual amount, whatever is the difference. If, say, for example, my liability component was 1,000 rupees and my component, the fair value of my compound instrument is 1,300 rupees, that 300 rupees will be the equity component. How do I classify this in the balance sheet? First, the liability component will be going in financial liability measured at amortized cost. Why amortized cost? Because this is not falling under your normal exemptions that we have been talking about. And equity, the balance will be recognized under equity component. Where in equity component is that there is a heading called other equity under the equity main heading, and that will be then classified as an equity component. So this is how the classification is done. I thought that the concept is interesting, and for that reason we thought we will cover compound instruments, these instruments where we exhibit both equity and liability components. Sir, this is early redemption of a compound instruments, and the next 2 points are, purely technical, and I would like to not confuse everyone at this point in time. So we will go ahead and we will take questions if there are any, and if we do not have questions, then I think I'll request the admin to request for a close.
Participant, is there any questions? Uh, Good evening, everyone. Now, at the end of this session, I would like to propose vote of thanks on the behalf of Nirmala Memorial Foundation College of Commerce and Science and WIRC. First, I would like to thank a special thank to our our guest speaker, Rishabh sir. Sir, thank you so much for being a part of this session. Really, this session is helpful to each and every person. Really, we loved and we learned a lot of things out of it. It's like, sir, if we are thirsty and we want to drink a water to satisfy our need, and if we have a glass but without water, so it is nothing na. So for that, we if we want to satisfy ourselves, we need a glass with water. Same condition is applied to us, sir. If we are accounting faculty and we know, we have a good knowledge of accountancy, but we don't know about the accounting standard, so we are like glass without water. We are empty glass. Thank you so much, sir, for helping us. Thank you so much for creating awareness about the accounting standard among the faculty. Thank you so much for everything, sir. And sir, sorry for actual inconvenience. A lot of things happen and lot of technical issues is there. So that's why we are not able to conduct the session properly. Sorry once again, sir.
No, completely all right. Thank you so much for having me. Thank you to the participant to listening so intently. I hope that the participants, my idea with this session, specifically financial instruments, was that at least the faculty that is there, they can have a very, a very hands-on or a brief idea as to what is financial instruments, what are these terminologies. I understand that this is 2 hours is not sufficient time to have this explained. Probably a 7-day series is required just for this topic. But what I was attempting to do is at least to give everyone a taste so that whenever they open a balance sheet next time or whenever they think about financial instruments or standards, they will be in a position to recognize what is said, why it is said, what is the context, what is the reason behind it. And thank you everyone for being with me and bearing through the technical glitches. And thank you to Nirmala Memorial Foundation as well and WRC of ICI for giving this opportunity. Thank you.
Thank you, sir. Thank you so much. Participant, please fill the feedback form, which will be posted in WhatsApp group. And one most important reminder is that your e-certificate will be generated within 10 days. And please don't leave the WhatsApp group. Thank you.
Thank you, sir. Thank you, Rishabh, sir. It was an excellent session. Thank you.